Hello, and welcome to our macro and strategy update. Is it still time to invest in small and mid-cap companies? In our view, yes, this is still the right time in Europe, including in Switzerland, despite high valuations. Indeed, global growth is going to stay above its potential for several quarters. European economies are more exposed to the global cycle, which is supportive for European equity markets. The global investors' repositioning in European stocks is not over yet. More specifically, within European equities, small and mid-caps are the best positioned to profit from this ongoing global recovery, because they are more sensitive to global growth. Small and mid-cap companies tend to be much more oriented towards the industrial sectors. In fact, it is the biggest sector, and it is taking full advantage of the current strong recovery in the global manufacturing cycle. Looking at small and mid-cap companies' earnings, they were badly hit last year, but are now recovering much more strongly than its large-cap peers. In addition, their balance sheets are sound. They register record levels of cash and have deleveraged since the Eurozone crisis from a few years ago. Despite its recent rise, their total debt-to-asset ratio is still lower than in 2009. Finally, small caps should benefit from a catch-up potential in terms of relative valuation. Small cap forward PE ratio relative to large cap forward PE are at relatively low levels, while for mid-cap firms, this ratio is close to its 10-year average. Thank you for listening and see you next week.